even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake. Yet none of these journalists who are invited to ask, Powell questions, understand enough about money or economics to ask the question or to point out that gold is flashing a warning, or they don't understand the warnings themselves.
As the Fed celebrated a strong economy and stable prices, financial commentator Peter Schiff highlighted a glaring omission: gold. He expressed disbelief that the metal, the world's premier monetary asset now held by foreign central banks in greater quantities than U.S. Treasuries, was completely ignored at the latest Federal Open Market Committee meeting. With gold surging toward $4,000, Schiff argued it should have been central to the discussion, as its price signals the true health of the U.S. economy and the declining confidence in the dollar. Ignoring gold, he said, is like ignoring a rising thermometer. The system is overheating, whether the Fed acknowledges it or not. In his analysis, Schiff explained that gold's recent pullback to around $3,950 is simply part of a consolidation phase, not a reversal. He pointed to his own forecast in his podcast, noting that dips below key support levels are natural before the next upward leg. Schiff compared it to gold's behavior at the 3,000 mark, emphasizing that the market continues to recognize gold as a haven against reckless monetary policy. With resistance now near 4,400 after recent highs, he maintained that gold's strength, even amid minor corrections, is a clear market verdict on the Fed's missteps, particularly its decision to cut rates when inflation remains a threat. What troubles Schiff most is not just the Fed's complacency but the failure of journalists to hold Jerome Powell accountable. At the press conference, no one brought up gold, which Schiff interprets as a sign of widespread economic illiteracy in financial media. He mocked the superficial questioning, suggesting that many reporters have to flunk an economics test before being allowed to cover monetary policy. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I want to talk about the one thing that wasn't discussed at all, that never came up once, and which should have come up, and that's the price of gold. $4,000 gold, the fact that gold had shot up so much between FOMC meetings should have been brought up, but wasn't. Gold was completely MIA at the Federal Open Market Committee meeting. Now, considering the fact that gold is the main monetary asset, central banks now have more gold than U.S. Treasuries, foreign central banks. You would think that the rise in the price of gold would at least have deserved a question. I think it should have been front and center. I mean, the Fed should have to address that elephant in the room. But no, the topic was never even discussed. And I've mentioned on my podcast that Alan Greenspan, who people call him the maestro, and he's still held in high regard, including by a lot of members of the Trump administration who speak about him. He specifically said that gold was his barometer of whether or not he got interest rates correct. That even though we weren't on an official gold standard, unofficially we were, because Alan Greenspan still looked towards the price of gold as a market indicator of whether or not rates were too high or too low. And so what he told Congress was $400 gold meant he was too loose, and $300 gold meant he was too tight. And so he was kind of eyeing for around 350. And so if the price of gold stayed around 350, that would indicate to him that he had got interest rates about correct. Well, if $400 gold meant that Greenspan was too loose, what does $4,000 gold mean now? What is that saying about the Powell policy? Clearly, if 400 was represented too loose money back in the 80s, well, then 4,000 certainly must represent the same thing now. And so that's why it should have been brought up. And by the way, my last podcast, I titled it Gold Test $4,000 Support. And some people might think, well, obviously it failed the test because now we're below 4,000, which is the case. We did end up falling below it this week. And in fact, gold closed below 400 today, although it did trade above 4,030 this morning. But it closed below it. As I'm speaking, we're up about $20, but we're still just below 39.50. But also on my last podcast, when I talked about 4,000 support, I did say that it was very likely that gold would go below 4,000 and that 4,000 could be support even if the market was to go below. Because I think it's going to be similar to the way we handled the 3,000 support. It wasn't like 3,000 was some line that we couldn't cross. And the same thing with 4,000. We get below it. But whenever you get below it, you are in a support zone. And just like the market never fell too far below 3,000, I don't expect it to fall too far below 4,000, nor do I expect it to stay below 4,000 for any long period of time, because that would give too many people the opportunity to buy it below 4,000. And I don't think that's going to be the case. So I still think that we're at 4,000 support, even if we're trading at 3,950. I mean, we're close enough to 4,000 to say this is where the support is. Obviously, the resistance now is closer to 4,500 because we did get up to, I think, 4,400 because we got up to like 4,380. So we didn't quite trade 4,400, and then we had the pullback. But even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake. Yet none of these journalists who are invited to ask, Powell questions understand enough about money or economics to ask the question or to point out that gold is flashing a warning, or they don't understand the warnings themselves, right? Because, they have to flunk a test on economics before they could be a journalist, an economics reporter at a lot of these newspapers or television networks. And then, then they get to ask these questions to Jerome Powell.
Peter Schiff sharply criticized Jerome Powell's optimistic portrayal of the economy at the latest FOMC meeting, calling it a complete fantasy. Powell insisted that the economy is in a great place thanks to the Fed's management of interest rates, claiming full employment and stable prices. Schiff, however, dismissed this vie, pointing out that the reality is far different. He found it particularly striking when Powell admitted that Americans are right to be upset about inflation, acknowledging that while inflation has technically come down, prices remain far higher than a few years ago and continue to rise even if slowly. Schiff agreed that this is a real problem but argued that Powell completely misses the underlying issue. Schiff emphasized that what Americans truly need are lower prices and higher interest rates to restore purchasing power and bring the economy back into balance. He questioned why the Fed continues to target rising prices through its 2% inflation goal when it acknowledges that prices are already too high. If the Fed truly cared about consumers and price stability, it would target falling prices, not rising ones, he said. Schiff highlighted the Fed's inconsistency, noting that when inflation was below 2%, the Fed justified running it above target to make up for it, yet now refuses to pursue policies that would bring prices back down, leaving consumers trapped in a cycle of rising costs. Let's get back to the interview.
Powell is talking about how great everything is. We're in such a great place because the Fed has done such a great job of micromanaging the economy with interest rates and making sure that we have full employment and stable prices. This is all a bunch of BS. On the Fed's watch, our entire industrial economy has disintegrated, and we've outsourced all of these manufacturing jobs, and we've replaced them with these service sector jobs. And we have this gigantic credit bubble, and Powell is completely clueless about any of this. Right? We're not even close to being in a good place. Now, let me look at a few other things that they spoke about. This I thought was really rich. So Powell admitted, because he was asked, why are the people still upset about inflation? Because you claim inflation's come way down, but people are still upset. And Powell says, yeah, they are upset, and they have a right to be upset. Right? He said the reason they're upset is because even though inflation has come down, prices have not. And he admitted that prices today are a lot higher than they were a few years ago. And that is why people are so upset, because the high prices haven't come down. In fact, they're still going up, right? So if prices were too high and now they're going up, even if they're going up a little, you're still making a bad situation worse. Now, I agree with what Powell said. Yes, the problem is prices went way up and they never came down. But whose fault is that? Right? Why doesn't somebody ask Powell, okay, then why are you targeting 2% inflation? If you admit that prices came way up and they never came down, why don't you target falling prices? Right? Why can't the Fed pursue policies to bring prices back down? Because that's what the public wants. Why can't they get it? Because remember, right, when inflation had been too low, according to the Fed, right, it was below 2% for a few years. The Fed said, oh, no, we need to average this up, right? Inflation's been too low. We've been below 2%. We need to average it up to 2%. So we need to run monetary policy a little hot, because we need to make up for all the years where inflation was lower than 2%. Well, if you admit that people are pissed because prices are so high and inflation was way above 2% for so long, why, based on the same rationale, why is the Fed not targeting inflation way below 2% to average all that high inflation back down and to deliver actual relief to the American consumer, who he claims he cares so much about, right? Oh, we're here to help the consumer with price stability. Okay, well, that means we need lower prices. We don't need prices to go up by 2% a year. We need prices to come down. And in fact, they need to come down by a lot more than 2% a year, because they went up by a lot more than 2% a year, right? If prices went up by 6, 7, 8% in a few years, why can't they come down by the same amount, right? I think people would be very happy, would be very relieved if they had that kind of price decline. But no, that's completely off the table, because as far as the Fed is concerned, it doesn't matter how high prices go up. They always have to keep going up, right? So if we have 1 year where prices go up by 50% in 1 year, the Fed wants to make sure that next year they go up another 2%. So you're at 52% and then 54%, right? We can't have prices go up 50% and then go down by 10%. Oh no, that'd be a disaster. We can't allow that. This is what Powell is saying. That's why this 2.5%, 3% inflation, you have to look at it in the context of all the inflation that preceded it. We do need lower prices. We need much higher interest rates to bring the price level back down. Instead, what Powell wants is, he said, it's going to take a while. We need wages to catch up to prices, right? And that way people can afford. So in other words, he wants more inflation so that people can get higher wages to afford the higher prices that resulted from the inflation of the past. But of course, the policies that he is pursuing to increase wages will also increase prices. So it's going to be like a dog trying to catch his own tail. It's never going to happen. In fact, Powell said that the reason they want to cut rates, right? Because he said we're in a good place, but we're in a challenging place. The good place is we got all this economic growth, we got full employment, but he said the risk is to the upside to inflation and to the downside to employment.
Gold's sharp rise toward $4,000 and the persistent high prices of everyday goods both highlight the disconnect between market realities and the Fed's optimistic narrative. While central bankers continue to claim control over the economy, key signals from gold as a monetary barometer to the ongoing burden of inflation on consumers point to deeper structural issues and policy missteps. Ignoring these warnings risks undermining confidence in the dollar, eroding purchasing power, and prolonging economic imbalances. True stability would require acknowledging these signals, allowing prices to adjust downward, and implementing interest rate policies that restore discipline to the market rather than perpetuate a cycle of rising costs. How does the Fed's current monetary policy affect gold prices and the real purchasing power of consumers? So stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.